Welcome to this case study, 100 marks, therefore you have 30 minutes to read the question. Remember, let's assume that you start with your reading at 7:30, therefore you need to be finished by 8 o'clock. The requirement, your first step, you need to allocate your minutes to each section, and then when you have to be finished with each section. Remember, I do this to save myself some time when I attempt these questions not to recalculate the remaining minutes. Therefore, I allocate the time when I need to be finished with my sections. I start at 8 o'clock. I've read the scenarios. 8:25, I need to be finished with part A. 8:40 with part B. 8:47 with part C, and so forth. Okay, let's read the scenario. This case study consists of 2 questions. Question 1. Ignore all taxes in answering this question. You are the technical expert of an auditing firm, ABC Auditors, that specializes in the international financial reporting standards. You have received the following information from 3 unrelated clients. Lethabo Limited. Lethabo is a manufacturing company and is listed on the JSE. Lethabo had issued 5 million ordinary shares at 10 Rand each at its incorporation to the general public. The share capital did not change since incorporation, except as is evident from the information below. In addition to its own activities, Lethabo holds investments in various local subsidiaries. None of the companies in the group are considered to be an investment entity as defined. The operations of the subsidiaries are closely related to the operations of Lethabo. The financial reporting framework applied by Lethabo Group is the International Financial Reporting Standards, IFRS. The financial reporting date of all companies in the group is 31 December 2019. Lethabo's functional and presentation currency is the South African Rand. You are responsible for assisting the Principal Director in finalizing the consolidated financial statements of the Lethabo Group, and the following information is available. The group's accountant has already prepared the draft consolidated financial statements. She has correctly accounted for all aspects unless the contrary is clearly evident from the information below. The group accountant requires your assistance in terms of the recognition of the change in control of Techno Limited. Right, guys, they indicate to us that there will be a change in control. Interest in Techno Limited. Lethabo had an 80% controlling interest since 1 January 2017. Therefore, immediately we know IFRS 3 and our IFRS 10 principles. Techno is not listed on the JSE Limited. Lethabo obtained its interest in Techno on 1 January 2017 for 4810000. On that date, the equity of Techno consisted of share capital of 100,000 and retained earnings only. Okay, guys, important. Identify that this is the equity, and this is at acquisition date 1 January 2017. The net assets on 1 January 2017 were as follows. They provide us with a carrying amount and the fair value. Now, when we refer to our principles of IFRS, remember, IFRS 3, so our parent has to pay a consideration to the previous shareholders at fair value, and the identifiable assets and liabilities should be included at fair value. Therefore, when we look at this, at acquisition date, which is 1 January 2017, do we use the carrying amount or do we use the fair value? We will have to incorporate the fair value, 5.5 million. Then they indicate to us that non-controlling interest were measured at fair value of 1195,000. The number of Techno's issued shares never changed since the incorporation until the current financial year. They indicate to us the NCI were measured at fair value, therefore this will be, or goodwill, NCI will share in our goodwill portion. Then, on 1 January 2019, Techno had a rights issue of 1 ordinary share for every 2 shares previously held. The new shares were issued at 75 Rand each. Lethabo took up 31,000 ordinary shares in Techno, and the balance of the rights issue were taken up by other shareholders, therefore our NCI. The retained earnings and profit for the year ended 31 December 2019 and the group records was as follows. Now, they provide us with the retained earnings since acquisition till 31 December 2018. Therefore, this is in our since period. And they provide us with the profit for the year, which is for 2019. And then look at the star here, guys. You can assume that these amounts are correct and all related IFRS 3 adjustments were included. Now, why do they indicate this to us? If we look at the acquisition, there's a difference between our carrying amount and our fair value. Therefore, if they did not indicate to us that the IFRS 3 adjustments were recognized, we should have still identified that there would be additional depreciation and so forth on our office buildings, factory buildings, intangible assets, and so forth. But they indicate to us here that they've already recognized the additional details or calculations in terms of our IFRS 3 transaction into these amounts. Right, then Katlego made a simple share investment of 170,000 Rand in the ordinary shares of Mbali Limited, an independent third party, on 14 October 2018. This investment was classified as measured at fair value through OCI. The fair value of the investment on 31 December 2019 was 165,000 and 2018 182,000. Why is this important to us? Because there will be a mark-to-market reserve recognized in our OCI. Accounting policies. Some of the relevant accounting policies of the Lethabo Group are as follows. All other items of property, plant, and equipment are accounted for in accordance with the cost model. Depreciation on property, plant, and equipment, excluding land, is recognized on the straight line basis as the items is used evenly over their useful lives. Investments in subsidiaries are carried at cost in the separate records of Lethabo, and then any cumulative gains on investments at fair value through OCI are transferred to retained earnings when the underlying investment is derecognized. Now, this is important to us. Okay. Khumalo Limited. During the year ended 31 December 2020, look at the difference in the dates. The directors of Lethabo approved a plan to merge with the activities of Khumalo Limited. Khumalo was a private company held by 28 individuals. Khumalo was a manufacturing company and produced a key component to the production process of Lethabo. Khumalo manufactures these components under a unique patent. The merger occurred on 1 August 2020. Do you see, guys, in our 2020 financial year? Details of the merger of Lethabo and Khumalo were as follows. All the assets of Khumalo were transferred to Lethabo on 1 August 2020. All the employees of Khumalo were employed by Lethabo, and they would basically still have the same work schedules, responsibilities, benefits, and salaries as with Khumalo. Khumalo settled all its liabilities before the merger. Lethabo settled the purchase price by issuing 3,500 ordinary shares in Lethabo to each of the previous shareholders of Khumalo. The shares were issued to these individuals on 1 October 2020. In addition to the ordinary shares issued, the 28 previous shareholders of Khumalo would also be paid an amount based on the actual profits of this division for the next 3 years. Financial years ending 2020, 2021, and 2022. The payment will be made on 1 January 2023. At 1 August 2020, it was reliably determined that an amount of 700,000 would be payable on 1 January 2023. Details of the assets of Khumalo on 1 August 2020 were as follows. Now, they provide us again, guys, with carrying amount, fair value. We have our factory building, plant and machinery, a registered patent, debtors and cash, and a total. Details of the performance of this manufacturing division previously in Khumalo for the period ended 31 December 2020 were as follows. Units produced 698,000. Profit for the year 398,000. And then they indicate to us that Lethabo's shares traded at the following values per share on the various dates: 1 August 2020, which is our at acquisition date; 6/4, provide us with the amount on 1 October 2020, and 31 December 2020. On 31 December 2020, it was reliably determined that an amount of 720,000 would be payable on 1 January 2023 in respect of the contingent consideration for the business combination. Lethabo irrecoverably elected, listen here guys, to recognize the liability at fair value through profit or loss. This is important though, hey? An appropriate discount rate, where relevant, is 9% per annum compounded monthly. Assume that interest is compounded monthly. Client 2, Covert Investment Management Limited. Covert Investment Management Limited is the asset management division of African Investment Limited Group, providing investors, individuals and corporates with a range of investment opportunities. African Investment is listed on the JSE. You recently observed the following. Covert Investment Management. We are passionate about investments and driven by the desire to provide you with a range of premium products. We've taken a fresh approach to our investments. Our offering comprises a pragmatic active investment range, best managed funds, as well as smart alternative asset management. Products and services overview. We invest our clients' money with an absolute sense of personal accountability, conscious of the fact that every investment decision we make affects the quality of someone's life. We manage the portfolios in line with our pragmatic value investment approach, with the objective of providing real returns to our clients. We offer management expertise across a comprehensive range of portfolios and structured investments. Portfolio selection is based on the investor's level of risk, tolerance, target return objectives, capital growth or cash flows, as well as investment time horizon. These are determined on the size of the investments, and you receive quarterly statements of the value of your investment. We offer a one-stop investment solution that takes market monitoring, asset management selection, and any unnecessary administrative responsibilities off your hands. During your planning of the audit for the year ended 31 December 2019, you discovered that Covert has, through its portfolio investments on behalf of its clients, recently obtained 39% of the issued ordinary shares of Corona Limited. Okay guys, so Covert obtained in Corona Limited, a newly formed public company. Corona issued its shares to the general public. Covert is the only investor holding more than 3% of the ordinary shares in Corona. Okay, this is important. Each share of Corona entitles the shareholders to one vote at a shareholders meeting. The relevant activities of Corona are directed at the shareholders meetings. You can also find that Covert holds equity investments in 17 blue chip companies and investments in debt instruments of 15 companies as at 31 December 2019. None of these investments constitute control, joint control, or significant influence. Client 3, HealthMed Limited. HealthMed is a company that provides private healthcare services and is listed on the JSE Limited. The company has a 30 June reporting date. In order to increase its market share, HealthMed Limited acquired a 75% interest in the ordinary shares and a 25% interest in the preference shares of FirstMed Limited on 1 January 2013. Since this date, HealthMed Limited exercised control over FirstMed. Guys, we know this by now. IFRS 3 and IFRS 10 principles should apply. The following is an extract from the trial balances of HealthMed Limited and FirstMed Limited on 30 June 2016. Look at this, 30 June 2016. And they indicate to us here, investments in FirstMed at cost, 700,000 shares, value 712,500, 25,000 preference shares, value 95,000. We have our ordinary share capital, our preference share capital, retained earnings, ordinary dividends declared, preference dividends declared. We have a mark-to-market reserve, profit for the year, deferred tax, trade and other creditors. Right. Investment in First Med Limited. On 1 January 2013, the equity of First Med Limited consisted of the following. Ordinary share capital issued at R1.50 each, and then preference share capital issued at R3 each, C.1.3, and we had an accumulated loss. Important. Remember, this is on 1 January 2013. This is at acquisition date. When we look at this, at acquisition date. Okay. On the date of acquisition, all of the assets and liabilities of First Med Limited were considered to be fairly valued other than land and a hospital building, C.1.2. Health Med Limited chose to measure the non-controlling interest in the ordinary shares of First Med Limited on the date of acquisition at fair value. On 1 January 2013, the fair value of the non-controlling interest in First Med was as follows. So ordinary shares 320,000 and preference shares 250,000. On date of acquisition, which is the 1 January 2013, the fair value of the land and hospital building of First Med Limited was determined to be as follows for acquisition purposes. The land 550,000 and our building 2.7 million. The property was originally purchased on 1 January 20.5 for 3.7 million, of which 3 million was attributable to the hospital building. The property was available for use as intended by management immediately, and the original estimated useful life of the building was 3 years with an insignificant residual value. The remaining useful life remained unchanged on acquisition date. First Med Limited accounts for the land and hospital building in accordance with the cost model of IAS 16. We know property, plant and equipment. Note 1.3. The preference shares of First Med Limited are cumulative in nature and carry a fixed dividend of 0.15 per share. On 30 June 2015, the preference dividends of First Med Limited was already in arrears for 4 years. Now this is important. Was already in arrears for 4 years. Health Med Limited accounts for the investments in subsidiaries at cost in its separate financial statements. The mark-to-market reserve for equity instruments of Health Med Limited on 30 June 2016 consists of the following. Other investments to the value of 612,800. On 1 October 2013, Health Med Limited sold hospital equipment with a carrying amount of 750,000 to First Med Limited for 950,000. The hospital equipment was available for use as intended by management immediately on 1 October 2013, had an estimated remaining useful life of 5 years with a insignificant residual value. First Med Limited writes off depreciation on the equipment on the straight line method over the estimated useful life thereof. 1.6. During the year ended 30 June 2016, Health Med Limited purchased certain pharmaceutical inventories from First Med. Okay, so guys, this is our intra-group transactions. If we look at this here, 1.5 is where we have our parent that sold to the subsidiary. Therefore, this will not have an effect on the analysis of owner's equity because there will be unrealized profit included in our parent's records. But 1.6, we have the subsidiary that sold to the parent. Therefore, this will have an effect on the analysis of owner's equity of our subsidiary because there will be unrealized profit included. Again, therefore 1.6, during the year ended 30 June 2016, Health Med Limited purchased certain pharmaceutical inventories from First Med Limited at a gross profit percentage of 15%. On 30 June 2016, inventories with a value of 207,000 were still on hand in the inventory records of Health Med Limited, after taking into account a write-down of 24,000 to net realizable value. On 30 June 2016, Health Med Limited still owed an amount of 132,000 to First Med Limited in respect of these inventories purchased. Right, let's briefly read through the requirement before we attempt each section. When we look at question 1A, we have 25.5 minutes. Relates to client 1. Prepare only the pro forma consolidation journal entries that relate to the change in ownership as a result of the rights issue by Lethabo Limited on 1 January 2019. Ignore all taxes. Now, only the pro forma journals. In terms of the change in ownership, 17 marks, therefore 25.5 minutes. B, client 1 also. Assume that for this part of the question that the merger with Khumalo Limited does represent a business combination. Therefore, we know our principles of IFRS 3. Prepare all the journal entries relating to the merger of Khumalo in the separate accounting records of Lethabo Limited for the year ended 31 December 2020. 9 plus 1 communication skills, therefore 10 marks, 15 minutes. C, client 2, briefly discuss whether COVID Investment Management Limited has power over Corona Limited. You are not required to discuss the concept of and other components of control in detail. Okay, guys, we need to only discuss power. This is only 5 marks, therefore 7.5 minutes. D, client 3, calculate the amount of goodwill, gain on bargain purchase, as it will appear in the consolidated financial statements of the Healthmate Limited Group as at 30 June 2016 in accordance with the International Financial Reporting Standards. This is 10 marks, therefore 15 minutes. Then we have E, prepare only the equity and liabilities section of the consolidated statement of financial position of the Healthmate Limited Group as at 30 June 2016 in accordance with IFRS. Notes and comparative amounts are not required. Round all calculated amounts to the nearest rand. 1 mark communication skills, not free but easy. Total of 21 marks, therefore 31.5 minutes. Note, all of the above is relevant to this question. You have to comply with IFRS. Assume that all current IFRSs have always been in existence. Clearly show all calculations and work to the nearest rand. Assume all items and amounts to be material unless the contrary is clearly evident from the information given. You are required to clearly indicate which component, part and or item of the financial statements is affected by any journal entry. Therefore, we need to indicate profit or loss, OCI, SFP, and so forth. Journal narrations are not required, therefore please don't waste your time.